Thursday, July 6th. Quick one-up video for you wonderful ladies and gentlemen. Although I am filming after midnight, smattering of economic data today, a little bit mixed, but with a pretty big skew to the upside. First, we had motor vehicle sales, better than expected. ADP employment number, much better than expected. Jobless claims, a little worse than expected, but not really that big of a difference. JOLTS, a little bit worse than expected, but roughly an inline number. And then we had EIA petroleum status report, which had a bigger drawdown than expected, so that fueled a little bit of a move in oil. Saw a liquidation break. We had discussed this as being likely in the midweek video. Bulls did, in fairness, buy it back up, but they didn't really take it up that much. It was a little bit of an inconclusive close, but we did close above the Fed Day highs, which has the potential here for arresting the decline. All eyes will be on watch for the jobs report on Friday at 8:30 a.m. If we get a hot number there, it's likely we're going to start baking in a second rate hike. July is pretty much a done deal. November is starting to look like they're pricing it in, but it's not quite there yet. My concern has been all along that the Fed is tapping us along on the way to 6% and maybe higher. Seems though that the market is factoring that in. The bulls have been kind of okay with it, but now we're bumping up against the metal here. 2-year at 5%, 10-year at 4% plus, and that's when the rubber sort of meets the road, keeps going. That could become more and more problematic. I've said for a while, though, I think that market has been okay because the economy has been kind of muddling along. We've seen very slow GDP. Granted, it was up 0.4 to 1.4, although overall a very low level that is trailing below inflation. So we are in a kind of de facto recession, even though the regime propagandists on TV don't necessarily want to admit that. A few of the reasons I think the market has held up better than expected are as follows. One was the PPP, the Payment Protection Program. It kept a lot of people in place in their jobs or had the ability to keep them on hand to be brought back. And that, I think, has helped keep the unemployment situation under control. Oddly enough, this could be part of the reason why we have a better than expected jobs number, because inflation is so high. People are now able to work from home and they have maybe 2 full-time jobs. I've heard a lot of people are working one job. They haven't told their employer, but they were hired by another company and they're working 2 full-time jobs, but not really working full-time jobs for either. So we'll be curious to see how productivity plays out here. Refinancing and locking in low rates. A lot of companies, basically the Fed said nobody's going bankrupt, and they took the opportunity to lock in crazy low rates that they couldn't normally get. And maybe in a year or two, when these roll over, they could have more problems. We may start seeing that as soon as this year or maybe even next year. I also think people refinance their mortgages, and now they have more money in their pockets to spend. And if you're not doing things like buying a big home, you have more money to spend on other things. And if you have a lower monthly payment, you can put that into various other services. Vacations, I told you a lot of people were going to Disney, although maybe not now as much, and other trips. We saw the petroleum drawdown, maybe more people are driving. Remember, during the pandemic, a lot of people bought a lot of cars, and they're probably doing these road trips. Supply chain shortages led to restocking. If you didn't have items and you had to buy them, that fueled a bit of a boom. Remember, during the Obama years, we'd have very slow economic data. We'd see this restock. Everyone got excited. They thought the economy was coming back until the numbers came in after those initial pop numbers. Things receded, and the market only kind of got going again once the Fed started doing QE. Paying people not to work was an odd thing. It gave people the ability to sock away money, and it artificially deflated the labor force. So now those people, as they draw down their savings, are forced back into the labor market. And I think that has been pushing down wages a little bit, but it has also been fueling the high numbers and people coming back into the workforce. Talked about in the midweek video, the VIX being at a low range. We did close over the 20 MA, even though the prior close was kind of weak. Today, we did see that pop. I had told you I thought we could get back up to 1706. And we got 1708 and pulled back. We did close below 1591, which is the 50 MA, and we did close just below the breakdown at 1553 and the down wedge. But I would say if we do start percolating back up over 1591 and get over 1706, there is room up to 18s and maybe even into the 20s, and who knows, maybe even a shot back up into the 21s. Low volatility ultimately leads to higher volatility. Doesn't mean it has to happen. I've told you I think the risk reward for the 1-to-1 payoff is for still lower volatility, maybe down into the lower teens. I think the move still higher is the 3, 4, and 5-to-1 payoff. I've mentioned buying puts or put spreads or even put ratios out in September, October, when markets tend to be seasonally weak and crashes tend to happen. On that put protection, super cheap now. If you want to fuel it, if you own shares, sell some upside calls. Makes sense to me, particularly if you're in Qs and in SPY. Key levels here. In the ES, bulls weren't able to clear 44, 94, 75. If they can do that and they can clear, then I think the potential is back to the upside. We weren't, we were bumping our heads, we got the liquidation break. I had told you the first target would be the Fed Day high at 44.39.5 and then 44.2475. We actually undercut that, but we're able to bounce. 44.39.5 plus puts the move back up to the highs. If we lose there and we lose 44.2475, then we're looking at 43.9975, 43.83 half, 43.71 half. In the Qs, very simple. Bulls never got back up to the highs at 15,475 half, and today they actually intraday took out the Fed Day high at 15,216. We had talked about a check back to 15,139 quarter. We had kind of, I don't want to say poor lows, but we didn't really have a lot of excess on the dead lows, and we were able to rally back. We can't hold 15,216. It's likely we retest those lows. 15,111 half. That can't hold. We'll come back down to 14,976 and we'll see the band of support down closer to 14,976 to 14,950 quarter. If that can't hold, the next big levels are 14,853 and then 14,722 and then 14,649, but we're not really quite there yet. If the bulls can, and I'm stressing can and they must, hold above the Fed Day highs, like I said, 44.39 half and 15,216, the risk is back to the upside. Anything below there, I think you could be short or flat. Anything above, I think you could be flat or long. So Fed Day high is the pass, don't pass line. On the jobs report, gonna get a spasm at 8:30. Keep in mind, anything inside that range is sort of neutral to bullish if it's up, neutral to bearish if it's down. If it takes out that low, let's just say that 5 or 15-minute spike low, anything below there remains more bearish. Anything above there remains more bullish. So I like using that spike move as a gauge for upside or downside plays. As far as SPY goes, we filled the 629 gap to 438. I had mentioned in the midweek video that we had 438 as the max pain level. After they filled the gap, we're able to run, and oddly enough, the max pain is right now at 439. So that would imply a flat move, maybe with a lot of gyration tomorrow. I'm keeping an eye on today's range also. In addition to, of course, the spike on the jobs report, anything above 440.10, which is the high of day, I think actually fills in the gap prior close at 443.13. The big question I have now, and we won't get the answer likely until tomorrow, was today's move, was the gap down a professional gap? Meaning, are we going to continue lower? This was the start of the summer correction. We will know that once we know if we can take out either the high of day, meaning we fill the gap and end one time framing and fill it back to the upside, or if we can't get above today's high and we continue on lower. And I told you I thought the next big levels to contend with would be 435.61 to 431.73, and I've told you that we have a fulcrum pivot at 431.18. If that is taken out, by the way, on this move, and it holds below there, it's likely we have a double top in, and we could see a larger correction. Generally speaking, though, anything that holds 20-day moving averages, and the SPY it's 436.45, we are bullish on. Now, if your stock today lost the 20 MA and came lower, a bounce back to the 20 MA is likely the spot to either book your gains or to try right or right out short. I like being long things above 20-day moving averages. I like buying dips on things above 20-day moving averages. I like shorting rips, anything below 20-day moving averages into resistance. 20 MA has been the guiding light for this rally since the beginning of the year. We will be long things above 20-day moving averages, flat or short things below 20-day moving averages. Very simple setup there. After that, we can contend with 50 MAs, 100 MAs, and 200 MAs. But for now, we are focusing solely on the 20-day moving average. If you're shorter term and you want to be Johnny on the spot, use the 10-day moving average. Those are very key ones, particularly for day and swing traders. The 10-day really for swing and day, and 20 MA more for position traders and swing. As Qs go, we didn't quite get the full gap fill to 363.81. That finished up fairly strongly. We didn't fill the gap, but if we were to fill the gap, that basically takes you back up to the magenta channel high. Now, if we lose the low of day of 364.52, obvious next stops would be the 20 MA. It's 363.46, which I don't necessarily think would hold, but I do think we could test back down to the magenta channel low and the 626 low at 357.858. That also, by the way, is a fulcrum pivot. If that breaks and we break magenta channel lows, then we're looking back to the October lows closer to 349.71 to 350.32. It may tie in with the 50 MA, which is currently 344.35 and rising. Basically, if we lose 20 MA, I think we test magenta channel midpoint and then maybe magenta channel low, which would dovetail with the October lows. Anything over 367.91 is bullish. Anything in between that range of 367.91 to 364.52 remains skeptical, but below 364.52, I think you got a clear short. Apple, they sold the channel high. We're still one time framing, even with the nice recovery today, which by the way did bounce off the 10 MA. I think there's a great little short setup there. If you lose the 10 MA at 189.54, I think you could play for a move back down to 186.29, which is the 20 MA, and maybe a retest of the breakout over 6.5 high at 184.95, which is also the green channel low. I do think that Apple will be a big tell, particularly in the next day or two. So keep an eye on that because that has been the big leader and it is still one time framing to the downside. You need to take out a prior day's high to end that. And remember, one time framing could end one period only. Anything more than that ends the one time framing and you're back to the upside. So let's say tomorrow, for example, we have a pop above the Thursday high that fails and we continue lower. The one time framing ended in one time period, but it resumed to the downside. So let's say it ends tomorrow, we go to the upside, and then Monday's up, it's over. So very simple setup there. Big gauge is Tesla. Not exactly very impressive here for the bears, but it is bumping up against the green channel highs. I think the risk to the upside is maybe 300. A check back to the 20 MA is basically down to 357.32, and like that 360-ish area, that has a lot of kind of reference support. I would be more interested in buying it on a larger correction to 217.65 to 206.86, which was really the breakout level. I booked some profits in Rivian today just because why not? It was up a lot. It stalled yesterday at the 200 MA. I used that opportunity to book some call spreads. Today, it was really not impressive for the bears. And I was noticing Rivian rallying earlier, and I actually put out a tweet that I thought it was acting pretty well. It did get up to my target, though, of 21.68, and toward the end of the day, I booked the short put version of that. That trade turned out to be a big winner. I am noticing, though, if it can hold strength, it is overbought, and today's rally was a little bit lower volume, so I am always a little suspect, but it could, if it holds here, get back up to 27s. So keep it very simple. I think 200 MA plus, which is 2086, keeps 27s in play. Below there, I'd be careful, particularly if there's a lower high tomorrow, because we could have a secure high at reference high, and by the reference high, I mean the 216 high. Sort of in this stick and move type of play. If we get a few days up and I get to target quickly, I just take the gains. I feel like we're up near highs and things have run a lot and they're running up the junk now like a Rivian. If you want to roll some of those profits, I know some of you took that trade along with me. 27s would be the move, maybe do some kind of a call spread or wait for a pullback. I'd probably do the time warp again if it got down closer to the 20 MA and 50 MA down closer to like 14s, 15s. The one stock that has not really recovered post-earnings is Nike, although I had mentioned to you I thought it would go lower. We are now getting pretty close to target down near 102.90, but I am not ruling out the potential for the gap fill down to 92.10, which would be back to the 11.9 close. If you want to do some kind of 1/2 put ratio down there, I don't mind that. I'll tell you, if you want to try long, anything over 106.09 makes some sense to me, but you've got to have a hard stop below 103.67 because that's the bottoming tail hammer. Always looking for a hammer to play, and where would I be playing to? To the 20 MA, of course, 109.73. Bounces to 20 MA, I think, are areas to trim into. If it somehow got back up to the 200 MA and 50 MA to up to 112.56 to 114.19, I might even try a short up there. I don't love pressing shorts down here, putting on shorts into pops after weakness. I don't necessarily like to press lows. I do like doing ratio plays into lows because you kind of want it to go against you at least initially because of the overwrite. And then if it does and you get some premium decay, once it comes down, that's better still. Override plays, particularly put ratios, are better to do into weakness. And if you are doing it into strength because you kind of want to buy the dip lower, let's say you like missed a move, but you think there's potential for a pullback, do a 1x2, smaller size. Trade location and position size are, and they're best done at trade entry. TLT continuing a bit lower here. We are now coming into that 99.35 to 98.66 support zone. That will be very key. That has held before. If it does rally back up, I think you could maybe get back up to the 20 MA, but that's probably it. And then maybe look to put the 1x2 on again. I still have the override on. It's not in trouble yet, but it would be if it doesn't hold. I've told you though, I'm comfortable getting long some of that closer to that gap fill, which was of course from 11.9 at 94.61, and I'm short the 95 put. So if I'm put the shares, I don't really mind it so much, and I'd probably sell some upside calls and maybe even look to add to that because I wouldn't mind being into the long bond, anticipating Fed rate cuts maybe next year. Keep an eye on TNX because that's making moves. It broke out the prior session and then up again. It has some potential resistance here at 40.91. So there is some chance for some cool off and rollback, but the bad news is if that clears, the next big move is 42.24 and maybe all the way back up to 45.33. The more the 10-year rallies, the more the stock market will not like that. PE multiple premiums are based on 10-year in particular is the one most people use in their DCF valuation. And the higher that goes, the more the out years are discounted and the less they're worth today. The present value of future cash flows goes down. We are making higher lows and higher highs there, so I am worried. I've told you, people have been ignoring the Fed. They've been ignoring higher rates, but that could only go on so long. I've told you money flow has been not confirming new highs. People have been getting very cocky. Still like booking profits. I'm not so much into buy the dip mode on a lot of the stuff that's been up that I just sold on 1 or 2 down days. I'd like to see them come down into fib retracements, 50% fibs, 61.8 fibs, or hit some moving averages that I could play off of, like the 20 MA, for example. If 20 MAs can hold, then I like bounces. If they fail, I like shorting bounces to that 20 MA. That's it.